The first thing we should do with every question is start with the requirements. And the requirements here was part A, calculate the consolidated gain or loss arising on the disposal of the equity interest in sit-in. So I'm not going to go through the sort of the traditional approach. I'm just going to focus on this question of this company called sit-in, and let's see what we can do in respect of it. What I would do is kick off by just trying to determine our group structure. And what do we find? Well, we've got our parent company called Grange. We've got a subsidiary called Park, where we've got a step up from 60 to 80. We've got a subsidiary called Fence, where we've stepped down from 100 to 75. And then finally we've got sit-in, where we've gone from 100 to 40. So sit-in becomes an associate. I think it's very important to get that picture of the company. Then if it was a disposal, and I know that I've lost control, and I'm thinking I've got 15 minutes in which I can do some scribbling or writing some nonsense, what I would do is I'd write out my pro forma. So I know that for the gain on the disposal of a subsidiary, where we've lost control, it's sale proceeds plus the NCI at disposal. Now, I can instantly put that in as a 0 because it's a 100% owned subsidiary. Plus the value of the remaining investment less goodwill at disposal less the net assets at disposal. So I'm going to focus on sit-in, and a quick look, what do we have here? Well, we've got an investment in sit-in of 16 in the group SFP. We're not given the individual assets and liabilities, so therefore I'm going to try to work out where else we've got information with regards to it, and it's note 3. So note 3 potentially is going to be worth 7 marks. That's my mental approach. On the 30th of June X9, Grange had acquired 100% of sit-in for cash consideration of 39 million. So I'm going to go to goodwill and say cost 39. Sit-in's net assets were fair valued at 32. So I'd normally say plus the NCI. Well, we know that the NCI is 0 less net assets. I've just been told that the net assets are 32, so therefore the goodwill in respect of sit-in is 7 million. So back up to the face of my answer. Goodwill at disposal, 7 million. There's no impairment. That's come from working number 3. On the 30th of November, Grange disposed of 60% of sit-in when its net assets were 36 million. So now I'm going to pop down to working number 2. I've set up just my standard workings, and I'm just going to say in respect of sit-in, we've got a fair value, and I'm going to work that out at the SFP date and the acquisition date. $36 and 32. So that's an increase of 4. What else does it say in that note? 3 million has gone through profit and loss, and 1 million has gone through OCI. So we're given the net assets at the disposal date in the question of 36 million. What else are we told? The sale proceeds were 23, and the remaining equity interest was fair valued at 13. So our loss on disposal is 7. That was worth 7 marks.
No,
Okay, so the examiner was actually being quite fair to us here because he knew it was a difficult question, so he was trying to say to you, I'm going to potentially give you 7 marks head start. They provided you can remember the formula, that was a pretty easy 7 marks. So let's always focus on the positives, okay? Always look at the donut, never look at the hole. Okay, that's my approach to exams. Focus on what we can do, let's not worry about what we can't. So in terms of looking at this, remember I said to you look at dates very carefully. When did this disposal take place? It took place on the 30th of November X9, which is the date at which we're preparing the accounts. So therefore, this figure of 13 is our associate value. Because it was at this date the company became an associate. So I'm going to go straight to my consolidated SFP and say associate value, this is from A. So it's not going to be the 16. And the difference between the 16 and the 13 is calculated, it's within this overall loss on disposal. Now, as far as that loss on disposal, that's taken to our statement of profit and loss, so it's going to flow through to group retained earnings. So let's go down to group retained earnings. Disposal of sit-in in part A. I'm putting through that loss of 7, like so. Okay, so that's using the information in part B information from part A in part B. We've worked out our group structure. Let's now work our way through the question line by line, traditional approach. The first thing that we see is PPE. So I'm going to go to PPE, add those figures across, and I've got 806. Next, we've got the investment in the subsidiaries, figures of 340 and 134. Both of these go to our goodwill calculation, 340 and 134. The investment in sit-in we've now dealt with, so we can forget about that. Move on to current assets. Current assets are not referenced against anything because I've done my referencing on the notes. So I work out the total of 920. Sometimes I get this wrong. That's what I try to do is I go through the additional information and try to see if individual items are being affected. Share capital of the parent is 430. Of our 2 subsidiaries, it's 230 and 150. So we set up a net assets working SFP acquisition, SFP acquisition. Share capital 230, 230, 150, 150. We've got retained earnings, 170 for park, 65 for fence. We've got OCE, 14 for park, 17 for fence at the SFP date. And we're also given the figures for the parent. Those go into working 5, as they always do. Parent, 410 and 22. Non-current liabilities, we can add those together. I've not referenced those to anything, so I'm going to take a gamble on 334. And current liabilities, I've got payables, I've got nothing referenced against payables. I have got some information on provisions. I'm not quite sure what's going on, so I'm going to add the provisions together, and they give me a figure of 20. So I will have picked up, I've already got 7 marks. What I've done to date will have picked me up another 3 or 4 marks. I'm around about 11 or 12. And we've not even got to the notes yet. Well, it's not far off it. More 11 than 12. More 11 than 12. The following information is relevant. On the 1st of June, Grange acquired 60% of Park. The purchase consideration was cash of 250. Always check, do the figures agree? And they don't. Why do they not agree? Because if you look at the final paragraph, Grange acquired a further 20% for a cash consideration of 90. So what I'm going to do is I'm going to say that there's a cost adjustment. I always check to see whether my cost figure is correct. We'd certainly pick up a mark for that cost adjustment. Excluding the franchise referred to below, the fair value of the net assets was 360. So let's go to the net assets. Fair value, 360. The excess of the fair value of the net assets is due to land, so we know we're going to have a fair value adjustment in respect of land. Park held a franchise right, which at the acquisition date had a fair value of 10. This had not been recognised in the financial statements of Park. Perhaps it had been internally generated and therefore you weren't allowed to recognise it under the rules. But a remaining life of 5 years. So what I'm going to do is I'm going to put through my fair value adjustment of 10, and that's an intangible fixed asset. Oh, sorry, I'm going to put that down here. Because it was excluded from that, isn't it? So that's my fault, didn't read it as sharply as I should. So I'm going to have a fair value adjustment of 10, and I'm going to go up and I'm going to have a new line for intangible assets and working number 2. Park still holds this franchise at the year end, so we need to amortise. And how much are we going to amortise? It's 1.5 years, or 18 months out of 5 years worth. So 10 times 1.5. The life is 5 years. So we're going to amortise 3. I'm going to take that amortization and I'm going to reduce the value of my intangible assets by 3 from working number 2. Grange wishes to use the full goodwill method for all acquisitions. The fair value of the NCI was 150 million. NCI at acquisition, 150 million. go to our goodwill calculation, plus NCI, 150 million. The retained earnings of Park were 115 and OCE was 10. So go to retained earnings, 115, OCE, 10. It then says Grange acquired a further 20% from the NCI on the 30th of November X9 for 90 million. So I'm going to set up a new working here, increase in investment in Park, and what have we done? We've gone credit, cash, 90. We know that we're going to debit the NCI, and we're going to debit or credit reserves with the balance. So therefore, we've effectively dealt with everything to do with Park. Now, because this question to me looks quite difficult, what I'm going to do is I'm going to take a slightly different approach. I'm going to do all of my housekeeping in relation to Park, because I know that there will be marks available for calculating the goodwill of Park and the NCI and share of profits and yabba, yabba, yabba. Because if we look down the rest of it, all of the other notes are to do with Grange. None of the other notes are to do with the subsidiary Park. So this is one of the advantages of reading the question before jumping into the question. So if I now go back to Park, I've got the fair value at the date of acquisition, and we can work out that our fair value adjustment is the balancing figure of 5. And we're told in the question that that balancing figure relates to land. Increase the value of land from working number 2, like so. So now we can work out our totals. We've got 370 at the date of acquisition. That figure is now up to 426. It's an increase of 56, of which 4 is an increase in OCE, and 52 is an increase in retained earnings. So what am I going to do? Well, I'm going to split that increase, because when did we acquire the extra shares in Park? Once again, it was on the final day of the year. So we don't have to split these gains on a time basis. So I'm going to take that increase of 4 and 52 and say, since acquisition for Park, the NCI during that period had 40% of Park, and during that period, Park's profits rose by 56. You don't have to split them between other comprehensive and retained earnings for the NCI. They just want their 40%. I don't care what the 40% is. So that is 22.4. And then I go to group reserves and say, Park, since acquisition, 60% of 52 and 4 respectively. Well, 60% of 52 gives us 31.2, and 60% of 4 gives us 2.4. So I'm sticking to my basics, and I'm picking up marks from my knowledge of the basics. We can also work out goodwill. Goodwill arises at the acquisition date, and at the acquisition date, the net assets were 370. So less net assets at acquisition 370. So that gives us a goodwill figure of 30. There's no evidence of any goodwill impairment in the question, again, because I've read the notes. So having done that for Park, I picked up another couple of marks. You know, and that is all from our F7 knowledge. Sorry? Yeah, you lost 1 mark maximum. Grange acquired a further 20% interest in the NCI, so what we can do is to say at the 30th of November X9, before the disposal, the NCI of Park was 172.4. That was for a 40% investment. Well, what happens at this date? They sell 20% of their shares to the parent. So transfer to the parent, it's going to be 20% of their 40%, so 20 40ths of 172.4 is 86.2, leaving us with an NCI total of 86.2. Now that figure of 86.2 that they've transferred to the parent goes into our adjustment for the second acquisition. So we now go to investment in Park, increase, debit the NCI. How much was that? That was 86.2, and therefore I'm going to debit reserves with the balance of 3.8, and that is taken to OCE. Okay, that would go to other, wouldn't go through your statement, wouldn't go through your profit and loss account, goes directly through to reserves. So that's OCE. So I'm going to pop up to working number 5, 3.8, increase in Park in working number 6. Note 2. On the 31st of July, we bought 100% for cash consideration of 214. And I'm scratching my head here because I'm going, oh, 214, I don't remember that. It's only 134. Oh, something's going a bit funny here. So a quick look down. Why is there a difference? Look, go to the final paragraph. On the 30th of November, Grange sold 25% of its interest in Fence to the NCI for 80 million. So this is going to be, remember I said these were reverse journals between step-ups and step-downs. So working number 7, disposal in Fence. I'm going to go debit cash 80. I'm going to credit the NCI with whatever it is, and then I'm going to credit or debit OCE with the balance. Now Fence is a bit trickier, but we know that we've got an adjustment of 80 million. So cost adjustment, I'm going to add 80 million like so. What was the NCI at acquisition? Well, we bought 100% of the shares, so the NCI at the date of acquisition would have been 0. Let's now read this information. The identifiable net assets had a provisional fair value of 202, including contingent liabilities. So we got here a figure of 202. At at the time of the business combination, Fence had a contingent liability with a fair value of 30 million. So this would be a fair value adjustment of 30 million at the date of acquisition. Because you do not show contingent liabilities in your accounts, you only disclose them as notes, but upon consolidation, they crystallise as liabilities. At the 30th of November, the contingent liability met the recognition criteria of IAS 37, and the revised estimate of this liability was 25 million. So what I'm going to do is to say the fair value adjustment at the SFP date, because it's a contingent liability, it won't be shown in the accounts, it's 25 million in the books of the subsidiary itself. The accountant of Fence is yet to account for this revised liability. However, Grange has not completed the valuation of PPE, and the valuation was not completed on the 30th of November 20X8, i.e. the last SFP date. It was received on the 30th of June 20X9. This is within the 12-month period from acquisition, so therefore we can make adjustments. And the excess of the fair value over book value was measured at 4 million. So I'm going to put through a 4 million adjustment. The asset had a useful economic life of 10 years at the 31st of July 2018. And this is where I thought the examiner was pretty horrible. So that's 1 year and 4 months we have to depreciate. We've got to depreciate it for 16 months. Now, why can't make it a year or a year and a half? I don't know. But in terms of depreciation, it's going to be 4 million times 16 months. What was the asset life? The asset life was 10 years, so that's 120 months. So I'm going to depreciate that asset by 0.53. Okay, that's what it will work out. Loads of people use 18 months. Some people use 1 year. Some people use 5 years. Don't know what. So I'm reducing the asset value by 0.53 minus 0.53 from working number 2. And of course, we've got the 4 million increase from working number 2 to deal with as well. The retained earnings of Fence were 73 and OCE was 9 at acquisition. So what have we got here? The retained earnings were 73 and OCE was 9. On the 30th of November, we disposed of 25% of the equity instruments to the NCI for 80 million. The disposal proceeds have been credited to the cost of investments. We've made that adjustment. So now, once again, there's a case for saying, because there's no further adjustments in respect of Fence, let's crunch a few numbers. So we've now got a revised fair value of the net assets at the date of acquisition of 206. And at the SFP date, it's a rather horrible 210.47. What's happened? And this is pretty horrible. OCE has increased by 8, which means that retained earnings have gone down by 3.53. During the period between the 31st of July X8 and the SFP date, we own 100% of Fence. The NCI own nothing. So, share of Fence since acquisition from working number 2. Retained earnings minus 3.53, OCE plus 8. Now, we've already got 18 marks. So if you had done just part A, the balance sheet, and notes 1 and 2, and effectively we've also done note 3, because we dealt with note 3 as well, you've done enough now to have passed the question. So there is a case for saying, if the examiner sets it out this way, go back to your basics, because you can work out that goodwill figure. You can work out your NCI total and so on. We can work out the goodwill for Fence because we've got the net assets at acquisition from working 2, and those net assets were 206. Therefore, the goodwill figure is 8. So the goodwill figure that we're going to take to our SFP is just the goodwill for the subsidiaries, because remember, the goodwill of sit-in disappears when it is converted into an associate. We're now in a position, and this next calculation is really unpleasant. Disposal of Fence, I've gone debit cash, 80. What have we done? On the 30th of November, Grange disposed of 25% of its shares in Fence to the NCI for 80 million. So what are we going to do? We're going to give the NCI 25% of the net assets of that subsidiary. So it's going to be 25% of, what were the net assets at that date? At the date of the transfer, if we go to working number 2, the net assets were 210.47. But it doesn't matter which number you use, provided you used the net assets at that date. Because what are we doing? We're giving them 25% of the company. At that date, the company was worth 210.47. But this is the sneaky bit, because we can't make an adjustment for the NCI because there was no NCI to adjust. There was the NCI, sorry, the subsidiary had another asset, didn't it? Which isn't in net assets. That other asset is goodwill. So this is the really sneaky bit. Because we're using the full goodwill method, the NCI had their share of goodwill. So that's why you would add it in. Okay, that's a nerd point again. Yeah, there's lots of nerd points in the questions, but remember, we've already got the 7 marks for part A, and we've already got at least 11 marks for part B. So everything else from now on is just making us prize winners. Okay, we can't all be prize winners, but. So that gives us a figure of 54.62 to give to the NCI, and the balance goes to OCE. It's 25.38. But if there were 2 marks available for that disposal in Fence, you would have picked up 1 mark effectively for just setting out the nature of the journal and trying to come up with some numbers. So as long as you know the principles, you'll pick up marks for those principles. So now I'm going to go to the NCI, and for Fence, I'm simply going to say from working number 7, 54.62. And I'm going to credit OCE with 25.38. Sale of Fence, working number 7, 25.38. So I've now dealt with note 1, I've dealt with note 2, I've dealt with note 3. Note 4, nothing to do with groups. For some reason I should have set this up. I don't know why I haven't. Working number 8, we've got an investment property here because we acquired a plot of land, plans for regeneration. It ticks all the boxes for investment property. It's currently held at a cost of 6 million in PPE until we decide what to do with it. So yeah, it's a classic investment. We're holding it until we know what to do with it. The market value at the year end was 8. At the 15th of December X9, this is reduced to 7, as there was uncertainty surrounding the viability. That's irrelevant. Yeah, that happens in the next financial year. So what I'm going to do here is I'm going to credit PPE 6. I'm going to debit my investment property 8. And what do we do with gains and losses on investment property? They are taken to profit and loss. So I'm going to credit statement of profit and loss 2. And this is why I say to you, always make sure you leave plenty of space on the face of your answer, because we now need an extra line. PPE minus 6, investment properties 8, that comes from working number 8. That comes from working number 8. And I'm going to credit profit or loss to investment property 2, like so. Note 5, Grange anticipates it will be fined $1 million by the local regulator for pollution. It also anticipates it will have to pay compensation of 6 million, although this is only the best estimate of the liability. In addition, the regulator has requested that certain changes be made. Well, requested is not a commitment. You don't have to make those changes. So I've got a note for provisions. We only provide for commitments using our best estimates at the SFP date. So that's going to be debit our statement of profit and loss, 1 to the government and 6 for compensation is 7, and credit provision 7. That's an F7 journal. So don't give up on questions. I know these are tough. So statement of profit and loss flows through into retained earnings. 7 provisions, that was working 8, and this is working 9. And I'm going to go to liabilities, and I've got a line for liabilities for provisions plus 7 from working number 9. Note 6, we've got an overseas property. So foreign PPE, this is going to be working number 10. And what I would be inclined to do, because it's in a different currency, I'm simply going to say dinars, rate, and dollars. I'm going to keep things simple. The original cost was $8 million when the rate was 2 dinars to the dollar. So it was 4 million dinars. At the 30th November X9, the property was revalued to 12 million. Notice it says depreciation on the property can be assumed to be immaterial. That's because the examiner loves us. He's given us an easy thing to do. He must have been feeling weak at the time he wrote that particular line. At this date, the exchange rate is 1.5. So now normally you say that PPE is part of non-monetary assets and you use the historic rate of exchange. However, should you choose to revalue assets, you always use the closing rate. So PPE held at cost is measured using the historic rate. PPE used at revaluation, we use the rate at the date it was revalued. So the revaluation is up to 8 million. So therefore we've got an increase in the value of 4 million. Debit PPE, 4 million. Credit revaluation surplus, which flows through into other comprehensive equity. PPE plus 4 from working number 10. Reserves overseas from working number 10, 4. So that's note 6 dealt with. Note 7, here the examiner took out his little book of evil and made something really uncomfortable for us. It says, let's just look to see what's happening here. Impairment, this is the impairment of the parent. Grange has prepared for reorganising the parent company's own operations. The board of directors has discussed the plan, but further work has to be carried out before they can approve it. So the first thing to say is stick to your basics. We cannot create a $30 million provision because there is no commitment to the plan. It's been discussed at board level. I know that they've announced it, but they've not announced the scale of it, so therefore we can't put in a figure. All it says is the plan will generate cost savings. The directors have calculated the value in use of the net assets of the parent as being 870 if the reorganisation takes place and 830 if it does not take place. We have to assume at this stage that it does not take place because we are not committed to it. The impairment, and this would appear to be a cash generating unit, Grange is concerned that the parent company's PPE has lost value during the period because of a decline in property prices, and any impairment charge would relate to those assets. Okay, let's try to work out what we have here. We compare the carrying amount per the SFP of Grange. Now, the carrying amount of the business as a whole is our equity total. If you go to the statement of financial position of the parent, can you see it has an equity total of 862? This is where it gets just ridiculously nasty, and nobody would get anywhere near this. we now have to go through the adjustments in the books of Grange. So what adjustments do we have? Well, the investment property, so I have to go through the notes, the investment property increased the net assets of Grange by 2 million. The provision for clean-up costs, that affected Grange, and that reduced the profits of Grange by 7. What I'm doing, I'm going through these notes one by one. So note 4 was Grange, note 5 was Grange. Note 6 was Grange because Grange owned the property. Overseas. So just to tidy up where these have come from, investment property was note. That's working 8, provision for clean-up, that was working 9, that was working 10. Is there anything else? This is the cherry on top of our cake. This is one which I would never have thought of in a million years myself. In the books of the parent, can you see the investment in sit-in is being shown at 16? We're now going to restate sit-in because we say its fair value is only 13, so we're going to reduce its value by 3 million. Not a single one of the 22,000 students who attempted this question mentioned that, I can assure you. But I've got to show you just for the sake of being complete. Don't worry about it, because if it's something that nobody's going to get, then you're not going to have to worry about it. So our revised net assets of the parent, or our revised equity total, is 858. The recoverable amount, we're told in the question, is 830. Therefore, our impairment is 28. Oh, what happened there? Oh God, something strange has happened. So the impairment is going to be 28. And I'm going to write that off. Oh. That's happened there. I'm rubbish. I loathe Microsoft Word as much as I love their tablet PCs. The impairment is 28. So I'm going to credit PPE and debit the statement of profit and loss. Let's go up to PPE. It's a long way up, isn't it? Minus 28 from working 11. Down to reserves, 28. Impairment, working 11. So we can now work out our totals. 400.67 for retained earnings and 58.98 for OCE. And we can take those totals and we can transfer them to the face of our statement of financial position if you've got time, and you haven't got time in the exam. OCE 58.98, working number 4. Retained earnings 400.67. We need to work out our non-controlling interests. 86.2 plus 54.62 gives us a grand total of 140.82, and we can transfer that to the face of the statement of financial position. So that's come from working number 4. In terms of provisions, there's one thing I forgot. The contingent liability, remember, in the respect of, was it fence or park? That should have been shown as a liability because once you bring it into consolidation at the date of acquisition, it continues to exist. So our provisions 52. So I did the other side of the entry to do that. Add that all up, 1770.47. Don't add it up in the exam, of course. Let's turn our attention to the assets. So intangible assets, we've got a figure of 7. We've got our investment in the associate, PPE, a grand total of 784.47. Add all of those up, 1770.47. And as Bruce Willis would say in Die Hard, yippee-ki-yay.